regular commentator from Singapore, Vandana Hari. Welcome, Vandana, founder and CEO of Vanda Insights. We see markets open up again today in Asia, Vandana, with the somewhat positive move yesterday. How do you see the markets at the moment?
Yeah, good afternoon from Singapore to you and everyone else joining us today. Sean, indeed, how the mood has changed. We closed last week quite gloomy. Europe setback in vaccination, big shortages, shortfall in supply was the dominating theme. And when markets opened on Monday, and especially in the West, it was like all signals in the oil market were flashing by. So what changed? First of all, I think in terms of the physical market, I think just the sort of the change of the calendar date to 1st of February served as a fresh reminder to the market that now Saudi Arabia is starting to cut production by 1 million barrels per day, which will continue through this month and next month. And, I was reading earlier today some very interesting buying activity. Interesting is a mild term. Shell came in to buy in the Platts MOC window, that the market on close, North Sea crude window, which of course reflects the conditions in the broader physical markets, but in turn also ends up affecting sentiment in the market. And we saw Shell was reportedly bought at least 5 cargoes and was looking for 7 more. So, I was reading that was like the biggest single purchase by one company in the MOC window in more than 10 years. So the physical market signs have been quite positive. The crude inflows into Asia in January so January arrival cargoes are said to be very strong. Some companies that monitor ship tracking movements are expecting Chinese imports to have gone up to 12 million barrels per day, of course, with the new quotas start for the independence with the new year. So physical markets were all saying buy. I think the financial markets also breathed a sigh of relief. The Reddit mania abated a little bit. So we've seen the US stock market rebound as well, and that has given quite a lift to oil as well.
We've certainly been for some time in the glass half full, glass half empty battle, and it seems, as you said, last week was very much a half empty week. This one seems to be very much a half full. Let's bring Omar Al-Ubaydli in from Bahrain, Director of Research, Bahrain Center for Strategic International and Energy Studies. While Omar, you can, by the looks of things, maybe still drive across the causeway into Saudi Arabia, while they're cutting 1 million barrels a day, they are also not allowing 20 countries as of today, suspending entry into the kingdom, including from the United Arab Emirates. So while we're in a glass half full week, we are reminded every day that there's still some very big challenges with the COVID pandemic.
Yes, and I think that in the case of Saudi Arabia and many other countries, this is as much about communicating. So with some of these almost knee-jerk or draconian bans on countries, I think sometimes the medical foundation for them is not completely sound. It's much more about sending a message to the general public, because the public has access to the daily data on COVID cases, and when people start to see the cases coming down, they tend to relax a little bit. So sometimes the government has to take what looks like a shocking and sharp action just to send a message to people that, hey, so the Minister of Health, who doesn't come out regularly in Saudi Arabia to give statements, but gave a very strong statement 3 days ago and again a couple of days ago, urging people to comply. And we're seeing similar things in many other countries. So in Bahrain and UAE, obviously cases are going up. Part of this, a huge part of this public health and economic battle is a battle in terms of communication and getting people to adhere to the guidelines. I was just speaking to Vandana before we started, and she said in Singapore, people are relatively compliant. But I think it's safe to say that in many of the leading economies in the world, that's not the case.
Yeah, it's clearly we're seeing across Europe even at the moment riots on the streets as people become increasingly frustrated with the lockdowns in Europe. Let's bring in Daniel Richards, senior MENA economist at Emirates MBD. Daniel, just looking at your Emirates MBD research note this morning, Europe, despite all of the challenges it faced, its growth in the fourth quarter was a little better than expected. What is your outlook at the present?
Yeah, so it came in a little better than was anticipated, but it still did contract. I think essentially what we're seeing now is that economies are getting somewhat better at managing to deal with the impact of the pandemic and related restrictions. Obviously, when this started back in February, March, April, whichever country was most afflicted by a rapid rise in cases, when that was a significant hit, governments and policymakers didn't really know how to deal with it. Could people work from home? Could people do this, that, the other? But I think now, even when restrictions are being brought back in, people are much more able to continue with their economic activity, not to the same degree as without restrictions, obviously, but that does make an impact, and we're seeing that in the economic contraction, but they are to a less severe degree than previously. As we go on with the ongoing vaccination rollouts, obviously there have been issues with that in Europe in particular, but some countries, UK, Israel, UAE, are doing very well at this. And as this continues, we would expect economic activity should start to normalize. But I think, as you mentioned, the pushback against that in some countries is not going to be a rapid thing. And I think the first quarter, at least, we have to be wary of being overly bullish with regards to the potential for growth rebound.
I also took a note, another comment in your daily note was the unemployment rate in Saudi Arabia touching near record levels at 14.9%, and the announcement of yet another job category for nationals, the call center, I believe it was. As we see this crisis unfold, how are the sort of nationalization programs across the region being seen as one tool to sort of counter the economic impact?
Yeah, especially, it was not only seeing it in Saudi Arabia, we're seeing it in other countries in the GCC as well, and that's perhaps inevitable. These programs had been underway for several years now, and as oil prices are set to remain lower, there are issues over potential to boost spending given wide fiscal deficits. We estimate that the GCC as a whole, the fiscal deficit averaged 11% of GDP last year, and that's the widest since 2015, I believe, last time oil prices slumped. So in this environment, there will be a political push to support citizens in a more robust manner, perhaps, especially as you mentioned, with the unemployment rate going up. So it's something that the UAE is not really pursuing, but other countries, I think, will likely see more of it going onward.
Well, I think it's worth noting there, isn't it, that last point, the UAE and the other side of the coin. Actually, this week, the biggest story perhaps in the region is the UAE announcing a pathway to citizenship, which of course in Singapore, Vandana, they've been doing for many years, and we've always modeled the development of the UAE and Dubai in particular on Singapore. And so finally, we have found a way to bring citizenship, and perhaps the economic stress of the current window has created the cultural context to allow that to happen. Vandana, looking at OPEC, they're meeting this week and signaling what the tea leaves might tell us of where they're going forward. We're 2 days into a unilateral Saudi cut of 1 million barrels a day. Without it, perhaps oil prices wouldn't be as vibrant as they are at the moment. Where do you see that cohesion going forward?
So I think the markets would probably be hoping that there are some signals from this week's meeting. Of course, we need to remind ourselves that there is no decision that needs to be taken anytime this month. The key decision, of course, by Saudi Arabia with regard to what to do with its voluntary extra 1 million barrel per day cut that expires at the end of March, and what the rest of the OPEC Plus does with regard to their cuts that also the current cuts that also expire at the end of March, those decisions will be at the start of March. So, they might just kind of sit tight, keep it under their hats. I'm not holding my breath to hear any clear signals coming. There might be a bit of a patting on the back. So far the January compliance has been very good. I think what has probably buoyed market sentiment, especially, is some of the early news agencies' surveys that have come out with regard to January OPEC production have shown that whereas the group had the leeway to increase production by about 304,000 barrels per day of the total 500,000 that under OPEC plus. They actually increased output by just a little more than half. So depending on who you're listening to, about 160 to 190,000 barrels per day. So that has been another factor contributing. But as I've been saying, and I think it bears repetition, I think next what we see them doing early next month, and whether those rifts between and the tension between the hawks and the doves open up again, I think that the really crucial decision time would be around a month from now.
It is interesting that these development prices rising yesterday, again into this morning, Omar, and yet we're also seeing the start of the the continuation, I should say, but start in the context of this year, the downgrading of demand recovery in 2021 is continuing. We saw it at the end of last year, IEA, OPEC, all each month, another few 100,000 barrels a day of downgrade. We saw it again yesterday. That trend continues, but yet the oil price seems to be moving in the opposite direction.
Yeah, I mean, as you mentioned, as Vandana mentioned earlier, it's just the rise in prices down to the supply. I mean, Saudi Arabia is cutting output by a huge amount, and at the same time, some of the factors which are unrelated to technical production and technical demand have started to. Some of the risk factors have started to subside. Remember, there was a lot of there was what has been described as an insurrection or a seditious uprising in the US not too long ago, and that was definitely making people very worried, especially in the lead up to the inauguration. Biden has now taken power smoothly, and he seems to be implementing his program relatively smoothly. Another thing creating up pressure on prices is the fact that the stimulus doesn't seem to be facing any political opposition thus far, or significant political opposition. Obviously, when it comes to implementation, then there will be additional question marks. But certainly that's a positive sign, as well as, in addition to that, the improvements in the vaccine rollout. So, a country like the UK, which in many aspects, sadly, of its handling of the pandemic has been shambolic, has been very competent, in fact, exceedingly competent in terms of marshalling its health system's resources to the issue of getting vaccines out there. It's also obviously been a key supplier in terms of the development of the AstraZeneca vaccine itself. So these are all factors which are positive and help overcome the contraction in demand growth forecast that you mentioned.
Omar, you were wanting to make a comment, I think, earlier on the Saudi unemployment issue.
Yeah, so you mentioned the nationalization policies.
Yes.
So, I mean, if you look at the history of these nationalization policies, it's been very much a mixed bag. And this goes back a little bit to the issue of the communication and signaling value of policies that Gulf governments often undertake. Many average citizens in the Gulf would like to think that the reason that unemployment is high is because of some sort of conspiracy to employ foreigners at the expense of citizens, when actually most of the desire to employ migrants is related to them having higher productivity and significant wage advantages. And as a consequence, if you deploy sort of coarse nationalization quotas, sometimes they do increase employment, but sometimes all they do is just decrease business activity in that sector and don't create jobs for the citizens, because the citizens may not be up to those jobs. And that's definitely happened in all of the Gulf countries. Now, Saudi Arabia is trying to be a bit more subtle about it, a bit more strategic by picking sectors where it feels as though the local labor market or the city where nationals are able to respond to the demands. I think you mentioned call centers in the past. It's happened in the financial sector, in telecommunications, which are sectors which have generated higher rates of Saudiization than other ones. But overall, these policies definitely need a lot more work before they can be described as being, overwhelming successes. And at the moment, it wouldn't surprise me if this declaration of this sector being Saudiized is more about sending a signal to the public that we realize unemployment is going up and we're doing something about it, than it is about actually.
And it's obviously not unique. I mean, this is a very common thing in most countries in the world. We see all the time categories of emigration that are tolerated. Daniel, back to Emirates MBD note this morning, a big emphasis on inventories in your report today, that inventories are declining. We saw an API forecasting this week a decline of over 4 million barrels a day, and the expectation that we'll get to the holy grail of the 5-year average sometime in the second quarter. Well, your outlook for that, and what is the consequence now of getting down to the 5-year average? Will we see, do you think, an acceleration, an upward move on price as the corresponding inventories fall? What's the bank's view there?
And our average forecast for the year as a whole is for an average of $50 a barrel. So our outlook for upside, I guess, is fairly limited over the year as a whole. It's some 14% up from the average last year. So that is the holy grail. Whether it will be achieved or not remains to be seen. Going forward, there will be greater pushback potentially with regards to these OPEC cuts. I know Iraq said that they would overcut again, as they did last year after missing targets. I think they actually missed that, as it turned out, last month. And given the very acute financial troubles we've got in Iraq, especially, the potential for ongoing cuts throughout the year and achieving this level, I think there will be greater potential pushback as we see. And then on the demand side, as Omar was laying out, for the time being, there is the outlook for a stimulus, that things will improve down the line, but over the next several months at least, travel will remain restricted. Long haul travel, even short haul travel within places, UK, for example, is still going to be working from home for likely the next several months, and that will be repeated elsewhere. So I think there's a lot of potential negative downside factors towards hitting that target.
Vandana, looking to Asia demand, which of course is the engine of everything, or certainly has been for last year, this critical window, and obviously years before, but certainly it underpinned the market last year, and China's story very well known. Now looking a little uncertain, India increasingly looking positive on the demand side. How do you think Asia stacks up for the rest of the first quarter?
So the optimism over steady, continued recovery in Asian demand is very much intact. Of course, China is a slight outlier at this moment in the very short term, because we know that there have been some outbreaks in the north and northeast of the country, which have prompted very localized, but nonetheless quite severe lockdowns. And we also know that generally across the country, the central as well as local authorities are discouraging people from traveling over the Lunar New Year season. Now, we do know that in China, traditionally, over January and February, which are the typical Lunar New Year months, industrial activity slows down anyway. So, gas oil demand, this is sort of a weak part of the year for as far as gas oil demand is concerned. But gasoline and jet demand usually picks up because of all the traveling, the hundreds of millions of people traveling, which will not happen this year. So while I mentioned earlier that the January buying, so January arrival cargoes was quite strong buying by China, the general expectation in the market is that February and March will perhaps calm down a bit. I think India is in a slightly different bucket. Indian oil demand reached almost 98% of pre-COVID levels towards the end of last year. And, I speak to a lot of people back home, and they tell me that, basically the country has moved on, and there's no looking back. to, what COVID did and what it might do, and there's no fear of second waves or anything. So it's moving on. So
just add it to the list of the multiple challenges that a country like India faces.
Oh yes, indeed. The budget was unveiled earlier this week, and they are spending, even if it means a bigger budget deficit. They are throwing a lot of cash at the economic recovery. We had the IMF saying last week, upgrading their forecast for India, growing at more than 11% GDP in 2021. So as far as Indian appetite is concerned, it's looking good. I think Japan and Korea, the other two major consumers in this region, are also looking good. Both of them are also going through the second waves of COVID, but who would know, right? It hardly makes it to the headlines because their second waves are nothing compared to what's happening in Europe and the US. But
I suppose, again, sorry, go ahead.
Just to add to Omar and Daniel's points earlier about demand, on a global level, I think the fear of demand suffering a setback in Europe are very, very real now with the delays in vaccination. And while the physical tightness is very real in the markets, we can see that. We can see in the physical market buying and selling, and we know what Saudi Arabia is doing. But as far as the demand outlook is concerned, I think it's very, very sentiment driven. So again, going back to your glass half full, glass half empty, half full, who knows, next week the sentiment might switch again, because the optimism over, yes, now we have Sputnik also been declared quite a success in the efficacy trials, 91.6%. But it's all sentiment driven, and that sentiment can change very quickly.
So it's so important, speaking with a number of producers in recent days, about the stability of the oil price as much as the height of it, in the sense that the volatility that has been seen as we start this new year, predictability is so important to planning. But now it appears that ultimately the question is, when do we break through $60 a barrel? It's a matter of hours, days, or weeks. Let's go to the room for an answer to that question, if indeed there is the view that is the case. OPEC sees OECD inventories returning to 5-year average in Q2. When would you expect oil prices to break through $60 a barrel? February, March, or April? I didn't put none of the above, but nonetheless, everybody can have a chance to, well, if you look at how much they've moved in the last few trading sessions, and if they did that over the next few trading sessions, would be at $60 a barrel. The ability to move is clearly there. Let's look a little bit ahead. Omar, what's coming down the road that would guide the market? Your thoughts looking forward to the second half of the week?
Well, actually, going back to the issue of the stimulus, I was reading a paper that was recently published, which looked at the effect of the first US stimulus, and it found that, of the, I think it was $1,000 checks that people were given, most of the money was spent on paying down debt or was saved rather than being spent, which is not actually what you want from a stimulus. You want people to spend the money. And this speaks to
you have to give it to the people who need it the most. They keep giving it to people who obviously don't need it as much.
Well, and also many of the things that people would like to spend on, which is holidays, going out to the restaurant and so on, they still can't do to the extent they want to. So that, that realization may take precedent, but we also have, so far in the first 2 weeks, Biden's team has been very successful in ramping up vaccination. And I think they switched their goal from 1 million a day to 1.5 million a day. Which means that hopefully by summer, the US could be very close to having, herd immunity, and maybe even earlier than that. So I think these factors are going to be important, because I think the ease with which the Democrats were able to garner political support for the stimulus definitely raises question marks over its the target recipients, as you mentioned, and whether the average man in the street really is getting the benefit of it. So I think that's going to be important. In addition to that, more of this vaccination fiasco. You mentioned the European demand being lower because of this inability to roll out. Fortunately, because the pharmaceutical companies are very competent in producing the vaccine, if Europe doesn't want to buy it or can't procure it, it doesn't mean these things are going sport. They'll just go somewhere else. And there's certainly plenty of demand everywhere else in the world. So in the grand scheme of things, Europe's loss is someone else's gain. And so I don't think the effect of that will be quite as big in net terms as one might mention.
Daniel, your thoughts second half of the week? I mean, clearly the American political scene remains to be a story on the stimulus, but it does seem that on that point, the Democrats are going to have to go it alone, that the Republicans are not going to give them the cover of a bipartisan approach. But second half of the week, any other data points you'll be looking for?
Yeah, well, likewise, Omar, I think that's really the key thing to watch at the minute is vaccination rollouts, new cases, and the US political scene. Will he be able to push it through? He did come through talking about being a unity candidate, but this is clearly taking precedence of getting a bill through on a reconciliation issue. And that seems to have, looking at survey results, that seems to have pretty broad, widespread support amongst American public. So
do you want $1,000 or do you not want $1,000? No, please. No, don't send the check.
Yeah, maybe it's a moot point, but so yeah, I really think that's the key thing to watch for. And given the way things are going at the moment, it looks like it will be a sizable stimulus push through soon.
Well, we're seeing in that point the vaccine impact. I mean, it's still early days, not 1% of the world population vaccinated yet. But in Israel, where it is 30%, there are some indications that where that has happened, it's had an impact. And hopefully we'll see the same here in Dubai. Before giving Vandana the last word, let's get the results of the survey question. April, so not a lot of bulls in the room. April seems we have to wait for April Fool's Day to have $60 oil. Vandana, your closing thoughts second half of the week, and I'd also welcome your comment on some of the notes in the chat room about the lack of capex investment and your thoughts on that.
Yeah, thanks. So I voted April on that. If you had something beyond, you had an option beyond, I would have probably gone for that.
Right.
But I would perhaps feel still comfortable saying April because that's when the summer picture becomes clearer. And to my mind, what is going to bring about a relatively sustained rise in prices from here is not the achieving of complete immunization, because we do know that's going to take several months, but the sort of lifting of the fog of the winter COVID wave from the Western Hemisphere. So I somehow feel it's a combination of science and gut feeling that I feel that things will start looking up in physical terms, in terms of economic reopening, the easing of lockdowns, as well as in sentiment terms. I think I would second Omar and Daniel. I think the US stimulus will remain very much in the market sites. We have had an exuberance return to the market this week. Part of it is driven by talk of budget reconciliation, which makes it easier for the Democrats to push it through. That'll be important. I think the other factor that has turned markets optimistic this week have been that the WHO on Monday saying that it seems that on a very global level, of course, there are differences between countries, but on a global level, the virus has been receding for the past 3 weeks. I think that's probably the most encouraging news one has heard on the COVID front in a long time. I think on the Sputnik front, I think that's also was very encouraging news yesterday. I think independent certification of the efficacy is, gives it a completely different aura. Being a Russian vaccine, and there's news that maybe Europe will now turn to Sputnik 5, and maybe that could solve some of Europe's shortage problems. So I think there will all of these remain supportive factors, but again, as I said, it's sentiment and it's very prone to changing very quickly. I did put in some comments in the chat box. I'm a bit surprised to see companies saying that their capex will be increasing. And I think it was Exxon, Mobil, if I'm not mistaken, both BP as well. A lot of their capex will actually be going into oil and gas. Look, if they say capex will increase, but more of it will go into emissions reduction and green energy, I would be inclined to believe that. It's really hard to see how they would be willing to and how shareholders will reward their increasing capex in oil and gas, in the current circumstances. But what a story on the Exxon Mobil dividend. I think that just stole all the headlines.
Well, if you want to get 7% dividend, you're going to have to put every dollar you have into new oil supply, or else you're going to have to borrow a hell of a lot of money, which will be problematic going forward. But perhaps we need to wrap it up there and let everybody get back to work. Daniel, thank you so much for your time this morning. Omar and Vandana from Singapore, really appreciate your half hour of insights. And to everybody else who joined us, have a safe and productive day, and we'll catch you later in the week. Thank you very much.
Thank you. Bye-bye.